Hey everyone, welcome to episode 301 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. But Matt, be remiss if I didn't start off with the tough loss for the Knicks last night.
Oh my gosh.
Now you're a follower of them, and now that they're playing the Pacers, and one of the Pacers players, Obi Toppin, used to play for UD, so kind of a love-hate relationship for you might be.
It was interesting that Pacers put on their social media, it was either last night or this morning. I saw it this morning. And it was never count us out. And it was Obi Toppin, a picture of Obi Toppin, because of the history between the two teams.
Right.
It's just interesting. The NBA playoffs is just razor thin margins of who's going to win these games. Just minute, differences in one play makes a difference.
Right. Yeah, crazy. I didn't watch it. I watched the highlights, but rip your heart out for Knicks fans, for sure.
It's tough to win game one at home.
Yeah.
It's tough.
Yeah. But getting back to it, before we get into this week's show, if you've been enjoying the Independent Advisors Podcast for a while now and want to take the next step in your financial journey, I'd encourage you to head to our website, jessupwealthmanagement.com, where Matt offers a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy, and once you land at jessupwealthmanagement.com, just click Schedule an Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts and as of the market close on May 21st. S&P 500 index up 4.9% for the month and down 0.6% for the year. The Dow Jones Industrial Average up 2.9% for the month and down 1.6% for the year. The NASDAQ Composite Index up 8.2% for the month, but still down 2.3% for the year. The Russell 2000 Small Cap Index up 4.3% for the month and down 8% for the year. And the Vanguard All World X United States Index Fund is up 4.3% for the month and up 13.3% for the year. 3-month Treasury rate at 4.36%, 2-year Treasury rate at an even 4%, and the 10-year rate at 4.58%. Moving into big headlines, current events from the past week. Matt, the one that everyone is talking about is Moody's downgrading the U.S. credit rating, which again is kind of a headline grabber per se. And I think once people saw that headline, at least I know I got some questions about it and how that's going to affect the broader market. But before I get into some of this stuff and explain it, do you have any comments or thoughts that you'd like to share?
It's a nothing burger.
Yeah. Okay. So no, it makes it easy. Moving on. Last Friday, for those maybe who didn't really read into this, last Friday, which was May 16th, Moody's downgraded the U.S. credit rating from AAA to AA1 or AA+, just ratcheting it down one notch, which Moody's was the last top tier rating for U.S. sovereign debt. And the downgrade was attributed, they said, to the nation's escalating debt projected to reach 134% of GDP by 2035 and their persistent failure to implement effective fiscal policies.
How is that new news?
Yeah, it's been going on for a while. So
I want to be careful on the soapbox right in minute 3 of the taping.
And kind of like we were just talking about, while this headline may seem scary on the outset, this isn't the first time this has happened. This has happened before, and the stock market returns following U.S. credit downgrades may actually surprise some people.
There you go.
So first of all, I just want to take a minute to explain who Moody's is and what they do. So Moody's is one of the big 3 credit rating agencies in the world, alongside of Fitch and Standard & Poor's.
Correct.
And they usually play a key role in the global financial system by assessing the credit worthiness of borrowers. So they will assign credit ratings to governments, corporations, municipalities, etc. And these range all the way from AAA, which is the highest quality, meaning it has the lowest amount of risk in their opinion, down to C, which is very high risk investment for debt, or they are getting close to defaulting or near defaulting. So the ratings just help investors and money managers gauge how risky it is to invest client money into a bond to figure out, hey, is this company in risk of defaulting on their debt, essentially, right?
Yep.
So going back to it, Standard & Poor's first downgraded the U.S. long-term credit rating from AAA to AA+ on August 5th, 2011. This was the first time in history that the U.S. lost its top-tier credit rating from one of the major credit rating agencies. And this decision was driven by, quote, concerns over political gridlock during the 2011 debt ceiling crisis and doubts about the government's ability to manage its fiscal responsibilities. This data is from Y-Charts, but 1 year later from that date, from August 5th, 2011, the S&P 500 was up almost 16% over the following 12 months. Fitch downgraded the U.S. credit rating from AAA to AA+ on August 1st of 2023. Something about the month of August for credit downgrades for whatever reason. This time it happened in May. The agency cited a, quote, steady deterioration in standards of governance over the previous 2 decades, highlighting repeated political standoffs over the debt ceiling and rising federal debt levels. Again, this data is from Y-Charts, but 1 year later, from August 1st of 2023, the S&P 500 was up 19%. So I'm not saying it's going to play out exactly like it has over the past 2 times, because that's a very small sample size. But if you do give investors time to kind of digest that information, you look out 12 months, returns are higher than average, actually.
Yeah, I think to me, this is more bond yields in America, in my opinion, is more in regards to inflation. And obviously, the deficit spending is not going to stop anytime soon, no matter who you vote into office. I mean, what politician is going to vote for significant budget cuts to balance it, to balance the budget? It's not going to happen. And so you have maybe a current administration, for better or for worse, that's going to try to grow our way out of it. Are they going to be successful? Who knows? I just don't see the trajectory on this changing anytime soon. And when you look at all the developed nations, it's projected will be at 134% of GDP by 2035. You got Japan that's like well over 200%. So, I said it before in the podcast, people will sit there and say, well, I just think we're at the limit. I just don't see how America can borrow more money. They'll borrow more money.
Yeah.
I mean, I hate to say it. I'm stating the obvious.
Right. Yeah. I think the TLDR is that scary headline, but when you look forward, really doesn't have that big of an effect.
Yeah, I think what happens is they're looking for a financial headline that's pretty easy clickbait, and I think it's a good excuse, and it'll get its run for the next couple of weeks, and then it'll run its course. Yeah. And I have a piece about the Japanese bond yields and the carry trade. That's a bigger story, in my opinion, and I'll be talking about that here in a little bit.
Okay. Moving on to tweets, articles, and research from this week. First thing I have was a snippet from Shane Murphy, who is a CMT. He has a newsletter that he recently sent out on May 17th. His newsletter is called Murphy on Markets, if people want to check that out. But just a really quick paragraph from the most recent note that he wrote. He said, quote, evidence-based investing will always win out against theory-based investing. One is grounded in hard data, while the other relies on modeling and conjecture. Since Liberation Day and the subsequent market sell-off, some investors have strayed from their strategies, fixating on incomplete data, game theory, and the opinions of so-called policy experts. But none of these are reliable pathways to superior market returns. There's a reason why, when markets become volatile, that institutions turn to their technical strategists to calm investor fears and focus on the facts. Price is a leading indicator. During times of high uncertainty, price can guide us toward more informed investment decisions. And I think this is a perfect example of what we just talked about. You had the U.S. credit rating downgrade from Moody's, and suddenly everybody's an expert of how that's going to affect the economy and the stock market, right?
We should have a little piece like in our podcast. What are people an expert on this week?
Yeah, and to me, the only thing that pays is price. So one might have thought that based on that headline came out after the market closed last Friday.
Correct,
right?
sir.
So I think people's initial reaction to that was stocks are going to be down a couple percent on Monday morning. It has to happen. Well, fast forward to this past Monday and stocks were positive again, right?
Yeah.
So a lot of the times when you think X makes Y happen, it's like X makes A happen, something completely out of the ordinary that you would never expect, right?
Correct.
So I just think that this is a really good reminder that price is the only thing that pays. We can have our opinions on how outside factors influence stock prices, but at the end of the day, if stocks continue to go up on news like a government debt downgrade, I think that tells you what type of market that we're in.
Yeah, I think another observation, and I know it's not a popular topic, but it needs to be discussed, is people taking their political opinions and stances and applying that to their investment portfolio. And it happened with Republicans when Biden got into office, and it's happening now with Democrats with Trump in office. And I think that is also, if you have a long time investment time horizon, right? And I think it's very dangerous to make investment decisions based upon your political beliefs.
Yeah. Yeah.
If you have a long-term investment time horizon.
Yeah. Agreed. Second thing I have is a post on X from Subu Trade on May 13th. So he says, yesterday saw a DeGraff breadth thrust, which is 55%, at least 55% of S&P 500 stocks hitting a new 20-day high. 3 weeks ago, we got a Zweig breadth thrust. Here's what happens when we get both thrusts within a month of each other. And Jenna will put this graphic up for viewers on the YouTube page. It'll also be in our show notes. But essentially what it shows you is when we get these breadth thrusts occurring very close together, forward returns tend to be very strong. So when they happen within a month of each other, 1 year later, S&P is up 100% of the time for an average of about 26%. Okay. So just to dig a little bit deeper on this, because a lot of this is technical jargon that maybe some people might not understand.
Okay.
Like he said in his post, the DeGraff breadth thrust occurs when at least 55% of S&P 500 constituents are making a new 20-day high. Okay. That's breadth thrust number one.
Got it.
Number two is the Zweig breadth thrust that looks at how many stocks are going up versus how many are going down on the NYSE or the New York Stock Exchange.
Yes.
So it calculates a 10-day moving average for the advancing stocks as a percentage of all advancing plus declining stocks.
Yes.
And if that number rises from below 40% to above 61.5% within 10 trading days,
Which is very uncommon of occurring.
a Zweig breadth thrust is triggered. And when I say breadth thrust, I mean a large number of stocks starting to go up very quickly at the same time.
That's a good way of saying it right there.
It shows that investor confidence is suddenly spreading across the whole market and not just a handful of stocks like we've seen in the past.
Well said.
So for what it's worth, another indicator that might suggest that the worst of it is behind us. Obviously, with the disclaimer that this time could be very different, but with all of these pieces of data that we've been talking about over the past several weeks as the markets continued to recover, I think the future is looking brighter and brighter at this point in time.
I agree. And let's take a step back and think about the calendar. Okay. We're almost smack dab right in the middle of the second quarter. Okay. A lot of people were selling at the end of March and beginning of April. So the second quarter ends at the end of June. So let's call it we're 5 weeks away from it. Okay. How popular do you think money managers and advisors are going to be if their clients get a statement in July that shows that there's still significant amount of cash assuming the market continues to stabilize? Do you think that's going to go over well?
Probably not, depending on the risk level of clients.
I'm with you. So generally speaking, that could raise some eyebrows. So my 2 cents on this, and this is just my years of experience talking here, I think if you get to the second or last week of June and things continue to stabilize, you might just see a melt up into the end of the quarter just on that alone. And just because they just don't want the statement to show that they missed out on what occurred since April 7th, April 8th. Don't discount that. Yeah. You could see a little late quarter melt up. I could just see Jenna taking that little snippet. She'll have it like time stamped. Matt said this on May 22nd and, show it like the first week of July. Just with my years of experience, I kind of see that's usually kind of how these environments go. Now, could they be right in that we fall right back? That is a possibility. This is not a guarantee.
Yeah.
Right? But it's just, if we, again, I'll say it one last time, if we continue to stabilize in this area, I just don't think it's going to be very popular to have that massive amount of cash by the end of June when clients get statements in July. Just something to be mindful of.
Yeah, we revisit that when we're getting near the end of the quarter here, about 4 or 5 weeks.
Yeah.
Next and lastly was a post on X from Willie Delwich on May 13th. And he said, again, yesterday's spike in new 20-day highs on the S&P 500 triggered the first digraph breadth thrust since December of 2023. The historical record in the wake of such thrust speaks for itself. And this just shows each time we have had that digraph breadth thrust just by itself, and the performance of the S&P 500 going forward over a forward 1, 3, 6 and 12-month time periods, and
quite the data set too, by the way.
It's quite robust and quite overwhelmingly positive.
25 or so data points ish.
Yeah. So looking forward, average return a year later, 15.5% positive for stock 97% of the time. So,
I'm dusting off the old. That's not bearish.
So it is. When we do start to see more stocks making new 1-month highs, 3-month highs, 6-month highs. Not always an indicator of it, but you don't see that a lot of times in what we might call a bear market rally. So just for what it's worth, you do tend to see these types of things happening when the market is bottoming.
Yeah.
So again, it could be wrong on that this time, but I like going off the data that we have, and that's what the data suggests.
You do a good job with that.
Appreciate that.
You do a great job with that. My first piece for listeners and viewers this week is just my reminder to keep an eye on long-dated bond yields. So to set the stage for this, Jenna's going to put up this illustration for our YouTube viewers. This specific piece will be in our show notes. It is a visual illustration dating back to 1980 of the U.S. deficit, and it also shows revenue. And then it's showing what the debt level is on top of it. And for me, I'm focused on the debt side of this. And what you're seeing, obviously, is the compounding, cascading effect of the debt level of the United States of America, right? And when you visually see it, and they break it down by, obviously, leadership, when you have a change at the White House, it's quite interesting when you look at it from this metric.
Yeah, it just goes to show you, regardless of if the president is a Democrat or a Republican, every person that's been in power has increased the debt. So it's like,
yeah,
I think there's a misconception out there that one party is more fiscally responsible than the other, but I think this just negates that. Right?
I believe so. So the next chart that I have is it's going to be of Japanese 30-year bonds. Now, why in the heck is Matt Jessup talking about Japanese bonds? Okay. So Lisa Abramowitz, she is an anchor at Bloomberg, posted this chart on May 20th. Jenna will put this up for our YouTube viewers. And let's verbalize this for our traditional podcast listeners, Mark. I'm going to let you just take 20 seconds and just illustrate what this is showing about bond yields over in Japan right now.
So it looks like they've gone from I mean,
Zero.
pretty damn close near to zero in 2019, up to almost 3.1% right now is what it looks like on the graph.
Yep. And it seemed to be accelerating. So what our listeners and viewers need to be educated on, and you can take this little tidbit, and next time you're at a cocktail party, you're at the church picnic, you bring up the Japanese carry trade, you're going to look really smart, okay? So what is the Japanese bond carry trade? So imagine you borrow money in Japan where interest rates have been super low, almost zero, as you insinuated. Then you take that money and invest it in another country where interest rates are higher, so you earn more. That difference between what you pay in Japan and what you earn elsewhere is your profit. Big investors and hedge funds do this all the time, and it works as long as Japan's rates stay low. This is called the carry trade, and you're carrying money from one cheap place to a more profitable one. Now, what happens if Japanese bond yields rise quickly? If interest rates in Japan go up fast, borrowing there suddenly gets more expensive. Investors doing the carry trade might lose money because their cost goes up and their profits shrink. That might make them rush to sell their investments in other countries to pay off the Japanese loans, which could shake up the global markets. This is the kind of panic that could cause big swings in currencies, especially the Japanese yen, getting stronger faster. It's like everyone trying to get out of the same exit at once. It creates a bottleneck and things get messy. So I would argue the media should talk less about Moody's and should talk more about things like this. Mm-hmm. And I know it's difficult to get the clickbait on such a topic. So the last chart I want to share is the U.S. 30-year bond yield. And I went into stock charts this morning. Jenna will put this up for our YouTube viewers. This will be in our show notes, Mark. This goes back 20 years. And the 30-year yield on U.S. Treasuries went back above the 5% mark. It got there a couple years ago as well. But before that, the last time it saw the 5 handle was back around what? 09?
2009.
Yeah, 09. So again, I think you're seeing some stickiness on the long end of the curve. And I think it's the market telling you, yeah, I'm concerned about the amount of debt the nation's taking on. I want a higher interest rate to compensate me for that risk. Doesn't mean the U.S. can't borrow money. Just means it's going to cost them more to do it. So what's the other option? They print it. What's the double-edged sword of printing money? Causes inflation. So the U.S. is going to have to figure this out. But the one thing that makes me feel good about what you and I do for a living is most of our clients are long-term investors, and their goal is to earn a rate of return greater than the risk-free rate. And if that risk-free rate is denominated in something where they're going to try to print their way out of it, I'd rather own physical assets. And I could throw that in as whether it's a stock, whether it's real estate or a hard asset, like even like a commodity, like a gold or a silver. There's other things, in my opinion, if you have a long-term investment time horizon, gets me more excited than a 10 or 30-year U.S. Treasury. I don't think it's a hot take. Someone might take the other side of it. Your thoughts and comments?
Yeah, I just think it's interesting that, over the past, call it 4.5 years, there has been a clear change in character of the way that U.S. government bond yields have been acting.
Well said.
For a long time, going back to, 04, 05, 06, yields have been in a steady, clear downtrend. Well, now they're in a steady, clear uptrend right now, and that could change, but this is the strongest performance, if you want to call it, that yields have had in 2+ decades, right?
Yeah.
Which just signals to me that it's a different environment than it has been for the past 10 years, and the market and returns for different areas in the market could look quite substantially different than it has over the past 10 years.
I'm going to build on that just for one more minute because this is an important point. I believe there is a perception out there that I buy a government bond, I can't lose any money. And if you buy it and hold that treasury bond until maturity, that is an accurate statement. However, if you buy a 10-year government bond and interest rates continue to go up, and you want to sell that bond a year later, you are going to have to take a haircut. You will have to take a loss. Why? When you originally bought that bond a year ago, let's just say it was at a 5% 30-year bond rate, hypothetically. And a year later, it's at 6. To entice someone to take that coupon that's at 5% instead of 6, you're going to have to take a haircut. You could lose money on that.
Right.
And I've said this on the podcast. This has been probably 4 or 5 years, Mark. But I remember saying back in the podcast that, roughly from 2010 to 2020 was just like an absolute bull market in bonds. People felt invincible. Mm-hmm. And I think the realization's coming back to where stock investors are like, welcome to the club.
Right. Well, yeah. And then there's the other misconception of, bonds are a safe haven, and it's like, They could act like it depending on which other asset you're comparing it to. But if you just take 2022 for an example, bonds were not a safe haven, right?
Yeah, well said. Everything got nailed in 22.
So, yeah.
All right, my next piece is going to be very quick. Small caps. Small caps continue their underperformance, record outflows. Bar chart posted this on May 19th. The underlying data source is Bank of America Global Investment Research. And really, Mark, what it shows is U.S. small caps have had their biggest outflows. Bank of America claims ever in 2025, with $68 billion coming out of small cap funds flows. It's pretty bad.
Yeah, I mean, small caps have been underperforming for a lot longer than people might have thought. I think we're still below the 2020 or 2021 highs at this point, and haven't recovered that. So, these are, some of the more risky stocks in the market. So eventually we would like to see this relative performance pick back up if we want to resume the next leg higher. But just over the past couple of years, the market's done fine without small caps leading the way.
Yeah, and let me help connect dots for our newer listeners and viewers, and maybe even seasoned investors who are listening to this. I think that there is a big correlation between long-dated interest rates and the performance of small caps. I don't have the data set to throw up here. I can't address it, but I'm just going to tell you, generally speaking, if you start to see long-dated interest rates start to come back down, I think you'll see small caps rally.
Yeah.
All right, next, and the perception is because small cap companies tend to have to borrow more money than larger.
Right, and we've talked about this on the podcast, but just really quick for people that are newer listeners, smaller cap companies, meaning they are smaller in size, they don't have the financial power of a Apple, Amazon, Microsoft, Nvidia, companies that have been around for a long time. So when they do have to borrow money to continue to fund their operations and reinvest in the company, people or companies that lend them that money view them as a riskier investment than lending money to Apple. Just is what it is. So
it is what it is.
For that investor taking that risk, they are going to demand a higher interest rate, right?
Yes.
So the cost of doing business for smaller companies increases substantially when longer term rates are high.
Well said.
So
thank you for that.
What it's worth.
My last piece, and then we're going to head over to Taylor, who has our financial planning topic of the week, Mark. My last topic is about, U.S. equities are still not getting much love by money managers. So a friend of the podcast, Ryan Dietrich, posted this on his X site on May 18th, Mark. And he was referencing a chart from Bank of America's Fund Manager Survey, the FMS. And what it does is it shows a percentage of equities and where the money is flowing. And in essence, all these fund managers, relative to history, this chart goes back about 25 years, you're going to see it's on the lower end of flows right now. So even though the market has recovered some, I'll just say it like that, off of the lows in early April, I've been saying on this podcast with other pieces of data points, it just feels like the institutions are not the one driving this market higher. Maybe a little bit, but the data points I'm seeing, large block trades, talked about that in the podcast, data points like this, I feel in my years of experience, this is more of like a seller strike that has caused this market to recover from early April. And just there's a lot of bearishness still with institutional money managers and U.S. equities. So then I want to connect the dots here, because when you went over pricing at the beginning of the podcast, listeners heard about how well stocks outside the U.S. right now are performing. Okay. So Mike Zaccardi, another friend of the podcast, posted this on May 19th. And the underlying source on this piece is JP Morgan and Bloomberg. And it shows U.S. and Europe first quarter 2025 weighted in median EPS growth, earnings per share growth. Okay. Jen will put up this chart for our YouTube viewers. This will be in our show notes. And what you're going to see here is that for the first quarter 2025 year-over-year growth, okay, you're going to see for the weighted, so the larger size companies by market cap, here in the U.S., 12.3%. Over in Europe,
Growth.
Growth.
You mean?
Thank you, sir. Growth of 12.3%. In Europe, negative 2.3% year over year EPS on the weighted side. On the median, U.S. was positive 6.2 and Europe was 5.1. I just want to throw it out there. It's like if someone said to me, Matt, you have to own European equities for the next 10 years, or you can only own U.S., one or the other. Is it really a choice?
Yeah, I think the thing for me, at least, is we've seen similar instances of short-term outperformance of international stocks or European stocks over the past 2 decades, like what we're experiencing right now, but it's never materialized into a longer-term trend change. And people might think I'm crazy for saying this, but to me, it still isn't enough. This relative outperformance from international stocks year to date still is not enough to get me excited or to make me more confident that this is a longer term trend change. So I need to see more, because we've seen this happen 3, 4, 5 times, like I said, over the past 2 decades, and it never materialized into anything. It was a short-term, couple of months, strong performance from international stocks, and then U.S. took the baton back over. So I just need to see more.
I agree. And again, what I just mentioned is my opinion, and just want to throw it out there that if someone were to call me up and say, Matt, hey, what do you think about us getting overweight international stocks? For the most part, I would be negative on that topic.
Yeah.
Before I bring Taylor on for the financial planning topic of the week, Mark, thoughts, comments?
Not much. I think over the next couple of weeks, it would be beneficial for the market if we did start to see some more longer term trade deals get done. So continued positive conversations with China. I know Taylor's going to talk about it a little bit here, so I won't steal her thunder, but there is, a tax and spending bill that's, I think was passed by the House this morning or yesterday.
What they vote, like 5 or 6 a.m.?
Yeah, I think so. That could have
Can't believe Congress is actually getting up that early.
Yeah, some significant impacts going forward. But other than that, like I said, we're kind of through earnings season. I think NVIDIA's kind of the elephant in the room that still has to report, which I believe is next week. But for the most part, pretty much through the majority of earnings season. So we get at least a couple weeks reprieve of hopefully slower news flow pertaining to publicly traded companies before we're right back up in Q3 reporting earnings for Q2.
Well said. One last thing. I had a client reach out to me after episode 300, where you and I were doing the kind of the lightning round questions. And they were kind of joking with me about my comments about Mac computers.
Oh, Mac computers. Are they for or against?
They were for.
Oh, interesting.
I told them they're not going to change my opinion.
Yeah. Until Macs look more like PCs, I'm going to remain on the PC train.
Yeah, you can get me on board potentially.
So,
all right, let's have Taylor on. Thanks, Mark.
Yep, thank you.
So for our newer listeners and viewers on YouTube, we highlight every couple of podcasts a financial planning topic of the week. We use this time to either highlight kind of real-time, legislation or topics that listeners and viewers might hear, whether it's things like estate planning or tax strategies, but really don't know how they work. So on the podcast here is Taylor Ledbetter. She handles all the financial planning work here at Jessup Wealth Management. Fan favorite, Taylor, welcome back to the podcast.
Yeah, it's good to be back. It's been a couple months, I think.
It has. I mean, we've been, I kind of use the analogy in a emergency room. We're in triage mode. We've been tackling the craziness headlines in this market, very fluid, as you know. But now as things are calming down a little bit, I'm not saying we're out of the woods yet, but it allows some more time for these types of topics. So I will turn it over to you.
Yeah, so kind of what Mark was just saying with the big tax bill, working right now. That's what I wanted to focus on, specifically the no taxes on tips, overtime, and Social Security. I know that you guys kind of briefly talked about this on last week's podcast.
Yes.
But just wanted to go into a little bit more detail.
Let's do it.
So first, just wanted to talk about the no taxes on tips. So the proposal, it's being proposed as a temporary deduction, not necessarily an exclusion.
Okay.
So those are two completely different things. With it being proposed as a deduction, that means it's still going to show up on the tax return. If it was completely excludable, it wouldn't be on a tax return.
Interesting.
But even though it's a deduction and it would be on your return, it would then be deducted like for or from AGI or adjusted gross income.
Okay.
And this would be for tax years 2025 through 2028.
Tax years. Is this retroactive to the beginning of the year?
I believe so.
Yeah,
yes.
I would believe it would be. Yeah.
Yep. So this would include any like self-employed individuals. So like Uber and Lyft drivers, they would qualify for this type of break. I know the Treasury is being directed at making a list of those that specifically qualify. So no, specific details on that yet.
Yeah.
Anyone who is highly compensated, meaning anyone who makes over 160 grand in 2025 would be excluded from this break. I know as of yesterday, the Senate has limited this deduction to $25,000 in tips being deductible.
Yeah. Otherwise, the concern there is someone just gets paid purely by tips.
Right. It's a way to work this system a little bit.
Sure.
But something else that's important to point out, even though it's deductible on maybe your federal return, it's still included on like your state and your local return. So you'll have those taxes.
Got it.
And it would still be subject to payroll taxes, so Social Security and Medicare.
Makes sense. This to me is I think it makes sense. I think it makes sense. I like it.
Yeah. Yeah, and kind of carrying into the no tax on overtime, that would also be a very, very similar situation. That would be for years 2025 through 2028 as well. Also being proposed as a deduction, not an exclusion, and still subject to the payroll tax and the state and the local tax.
Yeah, I think those are very popular things for a lot of voters on both sides of the aisle.
Yeah, definitely could deduct a lot of money. I don't know if there is like a cap, kind of like there is on tips for like overtime pay. I haven't seen anything specifically on any type of cap for that because, like I said, for tips, that cap is 25 grand.
Yeah, next time you're on the podcast, we'll have Jenna give you a reminder, and maybe we can throw that out there and give an update when the legislation passes if there's anything in regards to the overtime cap. How about that?
Yeah, absolutely. And then I think probably, a really hot topic would be the no taxes on Social Security.
Hot topic in our client base. Hot.
Yeah, so kind of wanted to clear that up a little bit. So a majority of people who do receive Social Security may not necessarily be paying federal income tax on that already. So according to the Social Security Administration, only about 48% of people who receive Social Security actually pay federal income tax on that.
I'm surprised by that stat.
Yeah, well, that's because of just how the Social Security system works.
Sure.
So if you only have Social Security income, you don't have IRA withdrawals, maybe you don't have any pensions.
Sure.
You're not really paying any taxes on that. But
Yep.
if you do have these other sources, it's going to
That's when it comes into play.
Yeah, exactly.
Yeah.
So this tax bill, there was no specific language in the bill or the chair's amendment that fully exempted Social Security from taxation.
Interesting.
Yeah, because as of right now, up to about 85% of your Social Security is taxable, depending on income. So I didn't see necessarily any changes with that.
Okay.
But this proposal, or what's going through office, does include a new temporary deduction of $4,000 again through 2025 through 2028.
Okay.
So what that means is right now, if you're 65 or older, you receive a additional standard deduction on top of what you already can deduct.
Got it.
So I know for single filers, I think the standard deduction is $15,000 for this year.
Yes.
And if you're age 65 and up, you would basically be able to deduct an additional $4,000 on top of that. So let's say 19.
That's how they're going to tackle this.
Yes. But this deduction would be available to taxpayers who itemize or take the standard, which I think that's kind of new.
That is new.
This benefit, it's phased out if you're a single filer and make more than $75,000 in taxable income. And if you are married filing joint, you're phased out at about $150,000.
Okay.
And something else that's important to note is that this isn't necessarily considered a refundable credit. So what that means is if your tax, say you'll probably have income of zero.
You're not going to get money back.
Exactly. Perfect way of saying it.
Yeah.
So yeah, I just kind of wanted to clear up the Social Security stuff because I know that's been really important with clients.
I think that's awesome, Taylor. Any other comments?
I guess not necessarily over these three things. I'm sure we're going to have, a lot of updates because Mark said that some stuff was passed by the House this morning, which I did briefly see. So yeah, I'll definitely want to dive more into maybe some other aspects of this bill, but I feel like these were kind of like the three most talked about as of right now.
Love it. I think the next time you're back on the podcast, just make a note to kind of highlight that. And I know Jenna can give you a reminder too. And I think I think our listeners would be very curious about that.
Yeah. Yes.
Right. While I still have you on, if you can feel free to chime in on this one, I'm happy to tackle it first. We had a listener send a question. The question from Tim was in regards to what is a junk bond? Like he's heard this term and just, Matt, what is a junk bond? So let's just tackle it. And we do welcome, questions from viewers. You can send those to inquiries at jessupwealthmanagement.com. So a junk bond, also known as a high yield bond, is a type of loan that a company uses to raise money, but obviously it's considered riskier than normal because the company might have a hard time paying it back. And since there's more risk, the bond pays a higher interest rate to make it more attractive to investors. My analogy is kind of like lending money to someone with like a low credit score or a lower credit score. They have to offer more to get someone to take the risk. Investors can potentially make more money with junk bonds, but there's also a bigger chance they could lose some or all of it. So Mark was talking at the top of the podcast, Taylor, about these credit rating agencies such as S&P, Moody's, Fitch. And when they apply a rating to these companies or countries, the over-under, if something is deemed to be investment grade, is triple B, and then anything kind of below that triple B, and there's some nuances to this, I'm generalizing, and below triple B is considered junk. And when I say the term investment grade, that means, and I'm very loosely saying these things, that means that a bank can invest its reserves in that bond. And so if it's below investment grade, a bank cannot invest its reserves into that bond. And so the investment world has kind of applied this line in the sand of investment grade versus high yield or junk bonds. And just because something is a junk bond doesn't necessarily mean it's absolutely horrible. You just have to assess that risk. Is this additional risk I'm taking? Am I incentivized with it? You know, you might be looking at a company that is maybe on the up, and they might be getting credit rating increases in the coming years. You might be anticipating that. Or the opposite could happen. You can buy something that's investment grade. They don't do well fiscally, and they get downgraded, and they go below that line and go into the junk side of the equation. So with all that being said, Tim, that's the general meaning of what a junk bond is and the different ways that the credit agencies would look at that. What you usually see are more professional money managers that would be doing the security selection on those types of bonds, similar to how one would do a security selection on an individual stock. Any thoughts or comments you'd like to add?
I think you described that pretty perfectly. I don't think I have necessarily anything to add. I think you said it very well.
Perfect. All right, we're going to sign off. So thank you for listening to episode 301 of the Independent Advisors podcast. Myself, Taylor, Mark, Jenna, I'll go down the list, Aaron, Nick. We all appreciate listening to the podcast, and we look forward to seeing you back next week for 302.